Now, in terms of analysis, we've got a fantastic team lined up for you round the desk here. We've got our go-to bond guru, Bloomberg opinion columnist Marcus Ashworth, and our long-time BOE watcher, Lizzy, Meakin, managing editor of our Daybreak newsletter. Welcome to you both. Marcus, let me start with you. Was this the right decision to hold rates, given we've got a budget coming up?
Yes, because it puts the pressure rightly square on Reeves, and she has got to deliver a budget which is both not too growth destructive, otherwise sterling will collapse and create certain problems, but more importantly, not inflationary. Unlike her one last year, which caused all sorts of problems and got right in the Bank of England's way. The Bank of England is saying, please get out of our way. And if she does deliver a budget which isn't inflationary, then I think they'll almost certainly cut. I think Bailey could have cut, and it was his decision not to. The fact that Breeden, who's been closely linked to Bailey's thought processes, has gone, I think that it means that if Reeves does a successful budget in far as the Bank of England's eyes concerned, they will cut in December, and indeed we'll get more cuts. And then our debt interest bill will start falling and everything will start working. If she also builds in enough fiscal headroom for herself, I think the gilt market will take this much more positively and will start to perhaps eradicate that spread we have over all other government bond yields around the world.
So you think Andrew Bailey's dangling a carrot at Rachel
big
Reeves
time.
here?
Yeah, and do you know what? Good for him. I mean, I don't want to get too into political, interference or independence of central banks, but this is really a symbiosis between Reeves and Bailey. If they can get it right together, if she can do what he needs to, and then I think we have a virtual, away from the doom loop, potentially something towards a virtuous circle.
Go on, Lucy, let me bring you in here. Were you surprised by the vote split? It's tighter than most economists thought it would be.
Yeah, I did not see this one coming. I was fully prepared for Sarah Breeden to go across. Swati Dhingra, Alan Taylor, yes, cuts. We saw that one. Sarah Breeden I did not see. Dave Ramsden I did see. But as Marcus says, Sarah Breeden is so closely aligned with Bailey. It's the first time that she's gone in the opposite direction to him. So this is really quite a big signal. And we were all watching Bailey because he's always been the swing voter that we've been looking at. Maybe he's, given her a little nudge to go that way.
Yeah, it's interesting that the internal members of the Monetary Policy Committee are dissenting, now Sarah Breeden as well. I want to bring in a former member of the Monetary Policy Committee now, and that's Michael Saunders, who's now a senior advisor at Oxford Economics. Good to see you as always, Michael. How would you have voted if you were on the MPC today?
I would have voted for no change in rates. I think the temptation is very strong to wait to see the budget. Also more information on CPI inflation and, crucially, more clarity on where pay deals are likely to settle for the next year. They'll know more about this in December and February, and I would expect them to cut rates at one of those two meetings.
OK, so do you not think that inflation's peaked at 3.8%?
Yes, I think it probably has. But the issue of the MPC is not whether inflation's going to fall. It's whether it's on a track to get back to the 2% target. The MPC are worried about an outlook in which pay growth is a little sticky and inflation would be likely to settle at 2.5 to 3 rather than go all the way back to the 2% target. So that would still be lower inflation than we have now, but not good enough from the MPC's point of view.
And where do you think neutral is? Because, of course, we don't know, but most economists reckon 3%. Is that about in line with your view?
So you could work out plausible estimates of neutral, which are anywhere between about 2.5 and 3 3/4. Personally, I would go for around 3 1/4. But you've got to acknowledge the uncertainty around that. And part of the reason why the MPC are being more cautious about cutting, skipping the regularly quarterly cut cycle that they've had for the last year and a bit, is because rates are closer to neutral, right? So it's less obvious that the future path for rates is downwards. And they've made the forward guidance such as it is. The rates are likely to fall further, provided there's further progress on disinflation. It's much more conditional forward guidance. It depends on inflation behaving as they would like it to.
Well, yeah, I characterise this as a dovish hold, taking liberties perhaps, Michael, but that is how the market seems to have read this. Is that how you see this, a dovish hold?
I think that's fair. They're trying to ensure that while rates are on hold now, the markets still see the scope for interest rates to come down further if the budget, the inflation data, and pay deals come out the right way. Compared to your discussion before about them just waiting for the budget, I would broaden it slightly and say that it's going to be the next few inflation figures and what they get back from the Bank of England's agent survey on pay deals that will be also important in their decision making.
OK, really interesting. We've just had the reaction from the Chancellor herself, Rachel Reeves, welcoming the cut to the inflation forecast, which, of course, they've just made. This is a new set of forecasts accompanying the decision. I wonder, Michael, did it give you pause in her speech on Tuesday when the Chancellor ventured to comment that 4% interest rates are constraining business borrowing? Some have said that that's a bit Trump-esque.
I don't know. I think that the Bank of England has said that they think 4% is a bit above neutral, so it's fair to imply that that's restraining demand. Obviously, it would affect both consumer spending and business investment. I don't read that as putting any pressure on the Bank of England. I think it does acknowledge that if inflation and fiscal policy do the right thing, then there should be scope for interest rates to come down further. Reeves will play her part in that through a tight budget. And that would be one of the things that should help the Bank of England to cut interest rates in the next couple of meetings.
Well, do you really believe that? She's just now repeated that pledge to cut inflation after this hold from the BOE. She made it on Tuesday, saying that the budget is going to be disinflationary. I wonder how she could do that and how the committee will have factored that pledge into their thinking today.
So the MPC won't have factored in what the budget might do. They will take the budget into account once the budget has been announced. That'll be for the December meeting. In terms of how the budget could affect inflation, you've got to distinguish between two slightly different things. One is the budget might have a direct effect on near-term inflation. For example, if the Chancellor cuts VAT on energy, as has been mooted, that would reduce inflation in the coming year directly. But it would only be a temporary effect. It wouldn't last beyond 1 year. Effect on MPC policy, probably pretty small. If the Chancellor tightens fiscal policy overall, raises taxes, cuts spending, that would dampen growth in the economy, and that would have a much more durable, persistent downward effect on inflation. And that's the kind of thing that could prompt the MPC, would allow the MPC to cut interest rates further.
Did the timing of her speech on Tuesday make you wonder whether it was targeted at the BOE, coming just right before a decision?
No, not at all, right? So the idea that the government are trying to influence the Bank of England, like directly asking them to lower interest rates, or that the MPC would listen to any such request, forget about it. The MPC take into account fiscal policy because, of course, it shapes the economic outlook. But it's only really through that channel. They're not subject to political interference in any way.
Just coming back to that vote split, Michael, something you and I have discussed lots of times is how it's used or not used as a tool of communications. Do you think that the BOE, and particularly the governor, were trying to send out a message here when you've got Sarah Breeden, a deputy, an internal member of the committee, dissenting?
No, I don't. The MPC members are individually accountable for their views. So Sarah Breeden has voted this way, not to try to send a message, but because that's what she believes is the appropriate interest rate. I think when they try to send a message, they do so through the monetary policy summary and the forward guidance, which there is. And that, I would think, indicates that interest rates are likely to fall further, provided inflation and the lead guides to inflation, such as pay growth, and also things which affect demand, like the budget, as long as those go the right way, then interest rates will come down further. So they sort of don't need to send a message by manipulating the votes. They have plenty of ability to send a message through their language, and they've chosen to do that.
And indeed, we've got plenty more language to flick through this time with the all-new kind of communications. But Michael Saunders, thank you so much, as ever, for joining us. Former Bank of England monetary policy member, of course, now senior advisor at Oxford Economics. We thank you so much. Now, we're going to be tuning into the press conference by the Bank of England Governor Andrew Bailey and his deputies very shortly. But just while we wait, Marcus Ashworth and Lizzy Meakin are still with us. And I just want to look at the market reaction here, Marcus, because we had seen yields lower off the back of the decision, but they've impaired some of that now. Do you think that the outperformance that we had been seeing for gilts in October is going to last all the way to the budget?
Probably, yeah. So I'm just started recovering from that delightful story I've just been listening to, which I don't fully believe. But what a wonderful world if it was really quite so innocent and independent of any form of influence, either from the government or to the Bank of England. But there we go. That's a diplomatic way of approaching it. Look, I think the markets are going to read straight through this, and I appreciate Michael Saunders' view. I just don't think the market is anywhere so innocent as to look at it that way. I think everyone is expecting a rate cut. Quite clearly, the body language from Rachel Reeves is she's worked it out finally what she needs to do, and I think we will see probably continued gilt outperformance. They've got a long way to get back, and I think there's plenty more room for gilt yields to fall. We'll obviously see what Bailey has to say. He'll countenance everything as ever very carefully. Eschewing any form of influence or that sort of stuff, but I don't think the market's got any time to believe that.
Yeah, Lucy, you've been to loads of these press conferences before. What would you be asking the governor today?
Well, what I would want to ask is what Rachel Reeves could do to derail a December rate cut now. Yeah. What could she do in this budget to make it go wrong? Oh, that said, I would not expect him to answer it, so it'd be a wasted question. I probably wouldn't waste my breath.
And you were talking about the optimistic view there when it comes to credibility, Marcus. If they'd cut today, would we be asking questions about the BOE's credibility?
Yes, we would, and I think they probably Bailey actively took the right decision and had to take the right decision. But I think Lucy was right to infer perhaps that Breeden moving across gives enough signals to everyone that needs to know that all things being equal, if Reeves does do, should we say, a logical thing and keeps her budget as disinflationary as possible, then in turn Bailey will be able can see through this and will be able to cut rates in December, or at very least tee it up very clearly and keep to this quarterly cadence which they seem to like. I think that would be a shame, but it's the direction of travel which is more important than whether or not they cut.
Okay. Well, great to get your insights, both of you. Bloomberg's Lucy Meakin and Marcus Ashworth of Bloomberg Opinion. We can go now to the press conference. The Bank of England Governor, Andrew Bailey, has just sat down. He'll be speaking to us in just a moment. Marcus is going to be staying with us, but we can tune in and listen to what the Governor has to say.
Well, thank you, Katie. Today we're presenting a new and improved package of communication reflecting the progress that we've made in response to the Bernanke review. In our minutes, the monetary policy summary is shorter and more focused, while individual paragraphs set out the views of individual members of the Monetary Policy Committee. In the Monetary Policy Report, a monetary policy overview sets out the main economic narrative underpinning our decision, and then we have a range of boxes which present the key pieces of analysis that have informed that decision. And the report now presents detailed scenarios with illustrative monetary policy responses in addition to the central projection. Taken together, the new report and minutes are designed to allow us to adapt and respond in a world of greater uncertainty, putting greater weight on the key judgments behind our decisions, emphasising the underlying economics as much as the precise numbers, drawing on a wider range of analysis and framing our discussions within a broader range of risks. So this is a milestone in the response to the Bernanke review, and one that is testament to the hard work and dedication of the excellent staff that do all the hard work. It is, however, today a moment of great sadness for us. During the preparations for the November meetings, we lost a much-loved and respected colleague, Pavandeep Dharmi. Pavandeep was a mainstay of supporting the MPC for a very long time. His insight and his commitment helped shape the documents that we've published today. And so we've dedicated this edition of the Monetary Policy Report to Pav. The new material presents more information about individual views on the committee, but I should say at the outset that we're here today at the press conference to speak to the collective decision made by the MPC, not the individual paragraphs. So on to the substance. Today we've held bank rate at 4%. The start of monetary policy has supported disinflation over past nearly 3 years now. And that progress has allowed us to cut bank rate 5 times, gradually making monetary policy less restrictive, while still seeking to ensure that inflation falls back to our 2% target and stays there. Headline inflation was 3.8% in August and in September, partly reflecting developments in food and administered prices. We expect this to be the peak. Beneath the headline numbers, underlying price and wage pressures have continued to ease. We expect headline inflation to fall to close to 3% by early next year before gradually returning to the 2% target over the subsequent year. But risks to disinflation remain, and we need to wait and see that the downward path of inflation becomes more established before we can cut our bank rate again. So where monetary policy goes from here depends on how two big forces play out. On the one hand, inflation is still well above the 2% target. It is possible that it could be sticky. For example, if increases in administered prices were repeated or if labour cost pressures continued to be elevated. There is a risk that the inflationary shocks we have had could have affected inflation expectations and the way wages and prices are determined in the economy. That could lead to more inflationary pressure. A scenario in the report illustrates that the path of bank rate might have to be higher than otherwise in response to that. On the other hand, activity in the economy is below its potential. We see this most clearly in the labour market, where the number of vacancies has fallen and employment growth has stalled. There is a risk that households and businesses remain cautious about spending and investment, holding back demand and weighing on job prospects further. And that could lead to inflation falling below our target. A scenario in the report illustrates that the path of bank rate might have to be lower than otherwise in response to that. Now, monetary policy is being set to balance these risks in order to meet the 2% target sustainably, and so that bank rate is neither too low nor too high. So today's decision is based on two key judgments. The first key judgment is that underlying domestic price and wage pressures are continuing to ease. Recent data suggests that the risk from greater inflation persistence has become less pronounced, and the risk to medium-term inflation from weaker demand more apparent, such that overall risks are now more balanced. As the central projection in the report illustrates and is reflected in the market curve, this means that we are likely to continue to be on a gradual downward path for bank rate. Chart 1, which has just come up, shows 12-month inflation in the Consumer Price Index since 2021, that's the white line, along with its components, the coloured bars. The increase in inflation over the past year has been driven in large parts by the contributions from energy prices, that's the orange bars, which are no longer pulling inflation down, and higher food prices, that's the purple bars, as well as increases in a number of administrative prices that have held up the contributions from services prices, and they're in the yellow bars. The shaded area on the right-hand side shows how we expect headline inflation to ease again in the coming months as lower domestic cost growth passes through to lower services price inflation. And as we look beyond the next 6 months, the effect of past increases in administered prices should also drop out. Provided they are not repeated next year, that should shave off another 0.5 percentage point or so from services price inflation in the second quarter of next year. As chart 2 shows, disinflation in underlying services price inflation has continued. Although progress had slowed in recent months, high-frequency measures moved lower in September. We expect the pass-through of non-wage labour costs, including from the increase in national insurance contributions, to continue to limit declines in services price inflation in the next few months. But we expect progress to resume next year. And the decline in services price inflation is supported by a gradual normalisation of wage growth. As chart 3 shows, annual private sector pay growth slowed to 4.4% in the 3 months to August, that's the blue line, down from 4.9% in the 3 months to May, and below the projection in the August report. This recent slowdown is consistent with the signals from a range of other pay indicators. And we expect wage growth to ease further into next year. That's the blue diamonds on the right-hand side. There are signs that disinflation is on track. But that is not to say that the risk that the recent rise in prices could feed into more inflation through second-round effects has gone away. The recent pickup in inflation has been driven in part by food and energy prices. These are salient to consumers and often affect inflation expectations. So we have to remain careful that this does not lead to any additional second-round effects on wage and price setting in the UK economy. But while it is only one data point, it is encouraging that the peak in inflation in September was about 0.2 percentage points lower than we had expected in our August projections. Looking ahead, over the whole of our forecast period, as seen in chart 4 here, that's our November projection, which is conditional on the market-implied path for bank rate. This suggests that CPI inflation will fall to close to 3% early next year and then decline gradually towards the 2% target after that. Further disinflation is being underpinned by subdued economic growth. Some economic slack is needed to squeeze out the remaining stickiness of inflation. A looser labour market eases the pressure on wages. And moderate demand conditions, combined with spare capacity within firms, limits the scope for firms to pass on higher costs to prices. As disinflation progresses, however, there is a risk that activity cools too much or for too long. In our central projection, we expect growth to pick up gradually to solid quarterly growth rates of about 0.5% towards the end of the forecast period. As chart 5 shows, while consumption growth has remained subdued, real household disposable income has recovered. That's the orange line. That should support a recovery in consumption growth in coming quarters. But the pickup in growth may prove harder to achieve if consumers remain cautious about spending in the face of high uncertainty and a weakening labour market. And it has become clearer when I've been on the road with our agents in recent months that the labour market is slowing too. And we see this in the data too. As measured by the ratio of vacancies to unemployment, shown in chart 6 here, further slack has emerged. Not just through a reduction in unfilled job vacancies, as over the past year, but also through an increase in unemployment. So this takes me to the second key judgment, that if disinflation continues, bank rate is likely to continue on a gradual downward path. The restrictiveness of monetary policy has fallen as bank rate has been reduced. So the extent of further reductions will depend on the outlook for inflation. A gradual approach allows us to assess the balance of risks to inflation, on the upside from more inflation persistence and on the downside from weaker activity, as the evidence evolves. As you can see from the vote today and from the committee members' new individual paragraphs in the minutes, making this assessment involves weighing the evidence on both sides. Different members have reached different conclusions on the balance of risks. Some members think something like the upside scenario is more likely than others, with the policy implications that come with that. Other members put more weight on something like the downside scenario, with implications for their views on policy. And with every cut in bank rate, how much further to go becomes a closer call. At this meeting, rather than cutting bank rate now, there was also an argument to wait and see that the downward path in inflation becomes more established. The latest data point on inflation was encouraging, but it was only one data point. Leading up to our December meeting, we will get more data on inflation and cost pressures in the economy to help us make the right decision, and we will be able to analyse how this year's budget might affect the economy and the outlook for inflation. As always, the MPC remains squarely focused on our remit to return inflation to our 2% target. Before I finish, I want to add a few words on quantitative tightening, as this is the first press conference since our decision in September to reduce the stock of government bond purchases held for monetary policy purposes by £70 billion over the year, from October this year to September next year. On the 11th of November, that's next week, the bank will publish its next quarterly assessment of transactions in the Asset Purchase Fund, where the bond purchases are held, along with a summary and projection of cash flows associated with quantitative easing and tightening under the indemnity to the bank. The upcoming APF quarterly report will include a new measure which will take into account wider implications for government debt issuance and servicing costs, including continuing savings resulting from quantitative easing. This will show a somewhat different picture on the costs. Looking ahead, the bank's policy is to meet the demand of the financial system for liquidity. Our approach is to transition to a demand-driven framework under which reserves will primarily be supplied by repo operations. This allows the bank to reduce the asset purchase facility in line with its monetary policy objectives and thereby reduce the exposures of the bank and the wider public sector to interest rate risk, whilst the bank provides the reserves through lending operations needed to maintain monetary and financial stability. This is important in supporting the operation of financial markets, including the gilt market, and in reducing the future exposure to interest rate risk. So with that, Claire, Dave and I will be happy to answer your questions. Thank you.
We'll start with Ed and then Maureen.
Sorry.
Hello, Ed Conway from Sky News. As you mentioned, Governor, there's a budget coming up later this month, and everyone knows, and the Chancellor has kind of signalled that there is going to be some fiscal contraction. Obviously, we don't know what happens until the budget itself, but I just wonder, could you give us a sense of the extent to which that played a part, just that the sense of this impending budget played any part in your decision or indeed the decision of the committee? Well,
thanks, Ed. We only know one thing with certainty. That is that there will be a budget on the 26th of November. Well, actually, I'll tell you a second thing with certainty. That will be before the next meeting of the MPC. So we will have opportunity to consider the budget in the next round. As I'm sure you know, because we've said it many times, we condition our view of the economy and our projections on announced fiscal policy. So the projections that you've seen here and that are in the report are conditioned on the fiscal policy that was announced in March. It's not for us to speculate what's going to be in the budget. That's for the Chancellor to announce in the budget, and we'll then respond to it.
Maureen.
Hi, Meakin Khan from The Times. Just to follow up, the Chancellor made quite an unusual decision to do a pre-budget speech, which actually was a lot about monetary policy. She kept repeating her insistence that she wants to help you out in the fight against inflation through her fiscal policy. Governor, given that you had the decisive vote, I'm interested in whether you didn't seem to have been convinced by her message, particularly given your assessment of the economy seems to be that actually the risk to inflation are a little bit less pressing, as you say in the report. And finally, the other message the Chancellor had is that everyone in the UK needs to be in it together. We all need to play our part. Does the Bank of England also need to play its part in the situation the economy and the public finances are facing?
Well, thanks, Maureen. I mean, in no sense are we passing any judgment on what the Chancellor said this week. As I've said, our very, very clear convention is that we condition our view on what's been announced. So we will do that. We have done that this time, and we will do that again next time. By the next time, there will be a new announcement. So we will have new fiscal policy to assess and condition our view of the economy on, and that's what we will do. So in no sense are we passing any judgment on what the Chancellor said this week. That should be very clear.
Sam and then Darshini, please.
Thanks, Sam from the FT. Governor, in your statement in the minutes, you allied yourself with a forward-looking Taylor rule and a similar market path, which points to 2 more cuts and things levelling out at 3.5%. Is it fair to say that, therefore, you now see 3.5% as a terminal rate for the bank? And could you give a sense of the debate and the range of views on the committee as to where the terminal rate would be? And just another follow-up on the budget. For you, again, personally, would it have been quite a closer call for you now in terms of cutting rates immediately if you didn't have the advantage of waiting until the budget had been held before and getting that on board before moving?
Well, let me take that question first, and I'll come back to the question on terminal rates. I think there's a very important point which I think you'll pick up not only in my paragraph but actually other paragraphs, which is, and I mentioned it in my opening remarks, we've had one inflation number which came in under our projection. That's obviously very welcome. I think it does suggest, as I said in my comments earlier, that we've reached the peak. But my own view is, and I think colleagues share this in some measure, that of course we really do need to see more than one number to establish that is sort of in the picture, as it were. So I will be looking very carefully at, as I just said, at the data that we will get before the December meeting. That will be a very important consideration for me. So yes, we will have a new fiscal policy by that stage to condition on, but really importantly, we will also have more numbers. And I'd emphasise that because we always have more new numbers, obviously. But the point is that we are at quite an important moment here, because we've had one set of inflation numbers which I think can give us some encouragement, can point us in a direction, but we need to see more than that. Coming back, your question on first of all, I think all of us chose our words very carefully. For me, the market curve at the moment does give a reasonable view of of a sensible path. By the way, that's not always the case. I mean, sometimes we've sat in this room and not been quite at that place, so I can't guarantee you that will always be our view. On the terminal rate question, I think it's probably quite clear also from comments, not only in this set of minutes, but in other comments the committee, as members of the committee have made in speeches they've made. I mean, we do divide somewhat into two camps. I don't want to overdraw it. There are those who I think who do take a view that, they do take a view on R-star and on the so-called, if you call that the terminal rate. There are those, and I'm in this group, who don't actually, frankly, feel that there is enough confidence around any measure of an equilibrium terminal rate, and that when we look at this question of restrictiveness, we're looking much more at the evidence on the sort of the change over time, as it were, in the path of restrictiveness, rather than looking at the terminal rate. But anyway, Claire may...
Yeah, happy to. We've set out quite a bit, actually, in the report in the risk sector. There's a chart 3.4 that shows you all the different ways that we look at this. I mean, our analysis is that policy is still restrictive. There's, as Andrew says, a difference of views. So much members have sort of raised this in their paragraphs about it. I mean, it's quite, determining how restrictive you are and issues around terminal rate, obviously quite complicated. It's quite challenging. It sort of gets more challenging as you lower rates, right? Yeah. So, we've sort of said that. But there's quite a lot of material in here that we've shown on this, and as Andrew says, the individual powers, I think, also give you a bit of a sense of how different people look at it. There is a difference of view, both about what the, debates and discussions around what the levels may be, but also around these more sort of philosophical questions about, actually, how do you know? How do you try and work it out? How important it is to you in thinking about your policy. And again, you can see that in the difference of views here, with it being a bigger issue for some people than for others.
The only thing I was going to add, because again, as part of what we've done today with, I'd agree with Andrew. This is a milestone in terms of responding to the Bernanke review. Is that we are trying to be as open as we can about, for example, the various risks. So one is this point about, just how restrictive is the monetary policy stance. I mean, just to reinforce something Claire just said, one thing that we've added this time, as rather than just repeat the mantras about that there's a range of views on restrictiveness, is that some of us do put more weight than others on these quantitative estimates. But there is something in the minutes in para 12 where we say that, as bank rate approaches neutral, the contribution of monetary policy to underlying disinflation would become harder to discern, making the case for further policy easing more finely balanced. So this notion that, because we've been able to reduce the degree of restrictiveness, we would all agree that we're getting closer to the neutral rate or the terminal rate. So, that gives you some sense also that the debate and the way we're thinking about this is inevitably going to evolve and change in the future.
Darshini, and then Halia, please.
Thank you. Darshini David, BBC News. Another budget one, I'm afraid, but in terms of last year's budget, because the MPC have been increasingly clear in your reports in recent months about the role that measures such as the increase in national insurance, national living wage, have played in increasing price pressures and wage pressures. To what extent has that contributed to hesitancy over the last year when it comes to the cutting of interest rates? And if I may too, I mean, you've highlighted the risks in the stock markets in recent weeks and months. In particular when it comes to AI stocks. Now, those concerns have gathered pace somewhat over the last few weeks. Can you give us an update on your thinking there?
Sure. I mean, I'll repeat something I know I've said before, but I think it's important and I can sort of update it a little bit. Of course, for us, the big question was how would the change in national insurance contributions pass through? What was going to be the transmission of it? It's something we spend a lot of time on. I mean, when I go around the country, I'm afraid it's the first question that businesses get from me usually, which is, can you explain to me how you've responded to it? And we've set out in the past that there are a number of channels working through sort of margins, employment, wage settlements, investment to improve productivity. That takes rather longer, and obviously prices. I think I've said before, in the early days, obviously, and they're not mutually exclusive, by the way, there was a sort of tendency to tick all boxes. I think over time, I would say that the two labour market stories have probably come a bit more to the front of the responses we get. So I say, people who are not, employment has reduced. Now, by the way, I think that comes more through not hiring than... We're not seeing much of a pickup in redundancy measures, for instance, but I think it comes more through the channel of not hiring. And I think some others then say, well, actually, no, our wage settlement was lower than it would otherwise have been. That, by the way, is also affected by the interaction with the national living wage, because if you've got more people around the national living wage, that channel is not as open as it would be if you haven't. So that's a relevant consideration. So I think we've picked up some more of that, as I would certainly say so. On the stock market AI question, I just say one thing about this. I mean, it obviously is something that we look at very carefully, and you'll be hearing that we're going to do it. The next thing we'll produce is the next financial policy report. So, you'll be hearing more about that on the financial stability report. But one thing I would say is this, because I think I've read a number of articles that have questioned this. It is, of course, perfectly possible and perfectly consistent that AI could be the next big mover in terms of productivity. So it could be the next general purpose technology. My own view personally is I think, more likely than not it probably is, but we've still got quite a way to go to actually sort of see that demonstrated. At the same time, we could have a bubble, because obviously the markets are pricing the future stream of returns from this, and that's uncertain. And so, those two things are not inconsistent. The markets could overprice the returns, but the returns could still be substantial. So we'll see. But we are watching obviously the implications for financial stability, and then the pass-through that could happen into the broader economy, such as covered here in the monetary policy report. We, of course, will watch that very carefully.
And just to reinforce that point on the reason we've also flagged this risk in the monetary policy report is because were that bubble to deflate or burst, that would represent a tightening in financial conditions, that would weaken global demand, and that would have spillovers back to the UK. So it is relevant to us on the MPC as well as the FPC.
Helia, in the middle there, and then Phil Aldrich. No.
Helia Ibrahimi, Channel 4 News. You haven't cut interest rates today, and clearly, Governor, you are the deciding factor. How do you explain wait and see to families at home who are struggling with mortgages and loans if you say inflation has passed its peak?
Well, I want to see more evidence that it's passed its peak. I hope it, I believe it has, but frankly, as I said before, in response to the earlier question, we've only seen one number so far. So I want to see more evidence. That's why, I've made very clear, you can see it in quite a bit of the commentary, including my own paragraph, that this is an important factor. Now, I think the best way I can put it is, I think these two big risks that I was talking about earlier have, in my view, become more balanced since we were last sitting here in August. I think that's the way to put it. But the best thing we can do for families, as you say, is get inflation back to the 2% target. That's not only the best thing we can do, it's the thing we must do. And therefore, I'm encouraged that we've seen this one number, but I do want to see more of it.
And inflation is at 3.8%.
Yeah.
So, I mean, that's a long way above the target. We're forecasting it will come back to 2%, and that's conditioned on the market curve. But 3.8 is quite a long way above 2.
We'll go to Phil here and then Joel at the back.
Thank you. It's Phil Aldrich at Bloomberg. There were 2 scenarios in the report today. I just wondered why one of those scenarios wasn't a fiscal scenario, given that the most immediate issue on the horizon is the budget, which it seems very clear that there's going to be consolidation at that point, and what that might mean for your reaction function. And just on, you mentioned regulated prices. The Chancellor is looking at, or supposedly looking at regulated prices. If she took action on that, would you welcome it?
I'll get Claire to come in on the scenario. Just on your points about regulated prices, can I go back to something, it's a totally fair question, Phil. Can I go back to something I said in my opening remarks? I mean, the important thing, of course, is what we see in terms of regulated price increases next year. Because obviously, sorry to state the blindingly obvious, but inflation is an annual calculation. So, we have these things called base effects where the effects drop out. The question, of course, is what comes next, and that will be very important. And I think that is a point that has been, taken by the government. I think you can see this from some of the things they've said. And I think if you go back to the point I think Darshini was making about what the Chancellor has said, I do think that it is a point the government has taken about the impact that these things can have on inflation and therefore on policy setting, and that's important. I'll hand over to Claire on the scenarios.
Yeah, and actually just on that, you can see the impact at the moment, the 3.8 number we're talking about. We think about 0.4 of that is these sorts of administered prices at the moment. I mean, on the scenarios, we've chosen these quite clearly based on the fact that they are the biggest issues in thinking about inflation and setting monetary policy to get it back to the 2% target. So, there is this question about how do we think about this balance across the economy of the risk that inflation proves to be more persistent for various reasons, whether that's structural change because it's been higher for a longer period, could be all sorts of issues. So that's one scenario that we have to think about and take very seriously and explore. On the other side, there is this sort of weaker demand scenario, which could come, potentially through the labour market or could come through what we're seeing in consumption, where, again, we've seen consumption being weaker than we've expected for quite a period of time. So we've selected the scenarios based on the fact that they are the most relevant things for the policy committee in thinking about inflation. And as you can see from the way in which different members have set that out, that framework is one that everyone's sort of consistently using and puts different balances on those 2 sort of forces, as Andrew described them, in terms of what's driving inflation.
Do either of those reflect the potential fiscal outlook from the budget?
So what we've done on the assumptions we raised, as Andrew said, what we do is we condition all of our work on the announced fiscal policy as it stands now. So that's the fiscal stance that was set out at the last budget.
Joel and then Philip.
Joel Hills, ITV.
Bank of England officials there speaking following the central bank's decision. You heard them under scrutiny from our very own colleague Phil Aldrich. And if you'd like to keep watching that news conference, you can head to Live Go on your Bloomberg terminal and you can follow along with all the latest news and analysis at TLIV Go. If you're just tuning in, recapping the decision so far, it is a hold at 4%, as most economists expected, so breaking with this cadence of quarterly cuts that the Bank of England did start last August. Of course, we've got a budget coming on November the 26th. We've got inflation at 3.8% here in the UK. But here, they've teed up a December cut, it would seem. It's a tighter vote split than had been forecast. The expectation was for 6-3. In fact, we got 5-4. Sarah Breeden, Swati Dhingra, Alan Taylor and Dave Ramsden voting instead for a cut to 3.75%. Breeden saying that she's now more confident disinflation is on track. And the Governor, you heard him there, saying that the Monetary Policy Committee is broadly split on the question of the terminal rate. Now, the guidance has had a makeover. They say that rates are likely on a gradual downward path. Previously, you'll remember they said they were taking a gradual and careful approach to rate cuts. They say now the overall risks to inflation are more balanced, and they see inflation below their 2% target by the second quarter of 2027. And an interesting note as well from the Governor on artificial intelligence. He says it could be the next big mover on productivity, but AI could be a bubble. So reiterating his cautious view on what he's previously described as stretched valuations and the implications for financial stability. Taking the temperature in these markets, the pound dropped on the decision, but it's pared those losses and then some, currently at a 130 handle, up 0.4%. The two-year yield at 3.78%. We are lower 2 basis points both on the 2-year and the 10 at the moment. And the FTSE 250 had been flat to the downside before the decision. Now it's up 0.1%. But we can get analysis now, more analysis, and I'm pleased to welcome former Bank of England Monetary Policy Committee member Martin Weale, now Professor of Economics at King's Business School, and Katharine Neiss, who spent nearly 22 years at the Bank of England and is now Deputy Head of Global Economics and Chief European Economist for PGIM. Lovely to have you both with us in the studio. Martin, let me start with you. Was that a dovish hold?
Well, I would say it is a fairly dovish hold. It does give the impression that there is room for rates to fall. We had people saying they weren't sure about the inflationary pressures and so on, but on balance, I think it was a dovish hold. And of course, the fact that it was 5-4, only one person needs to change their mind in December.
And how would you have voted?
I'd have voted to cut.
Really? With inflation at 3.8% and a budget round the corner?
Yes, I thought that the deflationary or the easing in inflationary pressures has been quite marked. The slackening of the labour market has been quite marked. In other words, I was agreeing with the sort of general view expressed by the people who voted for a cut. OK.
Katharine, how would you have voted?
So we've got a little bit of a difference, I think, here. Maybe that's more interesting. So my take is actually it is quite a hawkish statement. That's my immediate reaction. Not so much because of the decision. So I was with most economists and I thought that they would hold. I think they're likely to cut in December. I still think that. But I was a bit surprised by the prominence of this discussion around restrictiveness and where is the end point. So to me, it seems that they are signaling that the end point could be, closer than we think. I certainly had a view that we would probably end up near 3% by the summer. And now they're sort of signaling, I think, some distance from that, particularly Andrew Bailey. So from my perspective, the immediate reaction is a bit more hawkish.
I just want to play back one of the lines from Andrew Bailey, the Governor, in terms of the rate path ahead. Let's take a listen.
The extent of further reductions will depend on the outlook for inflation. A gradual approach allows us to assess the balance of risks to inflation, on the upside from more inflation persistence and on the downside from weaker activity, as the evidence evolves. And with every cut in bank rate, how much further to go becomes a closer call.
So the closer they get to neutral, the more carefully and slowly they want to move. Where for you is neutral, Katharine?
Well, I'm going to stick to my guns and say I still think that is probably some way south of the path that the Governor pointed out today, to say about 3%. Mm-hmm. But, one thing that we are being surprised about, and it's not just for the UK, but more generally for developed markets in Japan, even in Europe, is the surprising resilience of these economies, definitely compared to what people, I think, were thinking at the beginning of this year. And that would be suggestive of that neutral rates, the end point, is actually maybe just marginally higher than what we were expecting a few short months ago.
Martin, you said this was dovish, but the Governor just there said, I want to see more evidence that inflation is past its peak.
Well, that's a perfectly reasonable thing to say. I mean, remember that we've had, as he said, we've had 1 month where inflation was lower than expected, and the bank seems fairly confident that inflation is on the downturn. But to want to see more evidence is a perfectly reasonable thing to do. I think it doesn't stop the view being dovish.
Well, that takes us to the forecasts. Katharine, what do you make of the changes that they've made? Now you've got every member of the Monetary Policy Committee explaining their position. Instead of it being the forecast based on the best collective judgment, now it's a majority view. Are they sensible changes?
I think it's very sensible that they've got up front a paragraph for each individual member. There's more accountability, there's more clarity amongst the different positions and how to compare them sort of very succinctly. These paragraphs seem quite short. I was a little bit worried in some of the stakeholder briefing that we would get inundated with extra information that actually might inject more noise than clarity, but focusing on the statement itself and having these individual statements from each member, I think is very helpful.
Well, yeah, I wondered whether that might be part of the reason for the market reaction being a bit of a yo-yo.
Definitely. I think this was something I was signaling, to our portfolio managers, that there was going to be a bit of a learning curve here, given the change in the communications coming out of this round. And, I think it will take some time to know how best to digest some of this information.
Martin, one bit of advice from the ex-Fed chair, Ben Bernanke, that they've ignored is they're still using the market path for rates for the forecast. Is that wise?
Well, when you think of some of the alternatives, yes, I think it is wise because, no, the bank is nervous of giving a clear forecast for rates, and it would be doing that if it didn't use the market path. Or, I mean, it could adopt the constant rate approach, but people are much more interested in the market path. So, no, I think that they're right to go on doing that. Of course, circumstances may change in the future.
So the thing we haven't discussed so far, and the thing they really didn't want to discuss there at the press conference, is the budget. Of course, it's coming on November the 26th. The Chancellor's told us on Tuesday that it's going to be disinflationary. Do you believe her, Martin?
I think it is likely to be disinflationary. The Chancellor has to collect revenue from somewhere to fill a gap, and that won't be done if spending and taxes increase in equal step.
Well, Lucy Meakin made the point earlier. She'd be asking the Governor, what would the Chancellor have to do to derail a December cut? What do you reckon, Katharine?
For me, the two big things that the Chancellor needs to do is we need to see a decisive fiscal consolidation, i.e. one that has a sufficient amount of headroom to get rid of this fragility of these fiscal plans if outturns deviate only marginally from some of the assumptions in those projections. That, for me, is number one. That has been a big problem. And the second thing is I think that markets will be looking for some cuts to spending as being a more credible way of actually delivering a fiscal consolidation that is decisive. So I think that if those things don't come to pass later this month, that could be concerning and have negative consequences for the Bank of England. Because, of course, a decisive fiscal consolidation does help open the door for the Bank of England to step back in terms of the level of restrictiveness that's required.
Well, let's break down some of the potential options. What if she breaks the manifesto, Martin, and raises income tax or the payrolls tax or VAT?
Well, as far as I can see, if those taxes are actually raised and she doesn't just say this will come in 18 months or 2 years or sometime in the distant future, if those taxes are raised, that is, in some sense, revenue in the bag, or more or less in the bag. People may look for cuts in spending as well, but as we've seen, cutting welfare spending has proven to be extremely difficult or arguably impossible for this government. And
because of the left wing of the party?
Yes, and if you can't cut spending, then you have to pay for it through taxation. I think I'd also say that, in some sense, for me, an unsatisfactory aspect of the fiscal rule is that this gradually reducing debt-to-income ratio is in the future. No, in normal times, governments should be reducing the debt-to-income ratio to leave room for letting it go up in adverse circumstances.
Katharine, do you think the Chancellor overstepped on Tuesday by saying that BOE rates at 4% are constraining business borrowing, or is that just a fact?
It is a fact. There is this, sort of virtuous or vicious circle between the policy rates and the fiscal space. What needs to happen now, and what I hope that we see, is that we have this decisive fiscal consolidation that then, gives some relief to markets, which in turn, as I said, opens the door for the Bank of England to cut rates, which in turn would ease the fiscal pressures on the Chancellor, something I'm sure she would really welcome. So I think it's a fair point to have raised, because it is factual. but I'm not sure that it actually means that the Bank of England now needs to somehow factor that into its decision-making and sticking to their previous conventions of just sort of anchoring their projections off fiscal announcements that have already been made seems prudent and sensible.
I just want to play you both something that the Reform UK party leader Nigel Farage told our colleague Michelle Hussein on the Michelle Hussein show recently. Take a listen.
And what about the Governor of the Bank of England, Andrew Weale?
Well, he's a nice enough bloke, but...
Would he keep his job if you were Prime Minister?
Well, he's had a good run. We might find someone new.
Really?
He's had a good run.
So you are signalling you'd be
I'm not
prepared to
signalling
sack
anything.
him?
I'm just saying...
This is shades of President Trump and the Federal Reserve.
If Andrew Bailey wants to get with the 21st century... And by the way, there's one encouraging thing, because I went to see him last month. He just put a limit on the number of stable coins any individual can hold. I said, Andrew, this is ridiculous. This is dinosaur-like. And within a week, he changed it. So maybe he was listening. But the Bank of England, the British government, the regulator, whatever shape that takes, they've all got to understand that the world is changing, has changed very, very rapidly.
So just as my final question to you, Martin, we know the Governor's term ends in 2028, so he might not overlap with a Prime Minister Farage if indeed he ever makes it to Downing Street. But are you worried, given the polls, about UK central bank independence?
Well, I think people have realised generally that central bank independence isn't as much a fixed point as they had thought, but we have seen what it's delivered over the period since it was introduced in '97, and notwithstanding the problems we had a few years ago, whose shadow we're still in, I think it has been a great success, and I'm sure Nigel Farage can see that. His voters wouldn't appreciate the increased interest rates that would be likely to arise if the bank weren't independent.
Well, it's great to have both of you around the desk with me. Former Bank of England MPC member Martin Weale and Deputy Head of Global Economics and Chief European Economist at PGIM Katharine Neiss. We've got an interview with